Hi there folks, it's James Marley here from Livewire and welcome to this episode of Views from the Top. I'm joined by small cap guru Oscar Oberg, lead portfolio manager at Wilson Asset Management. Oscar, great to catch up. Thanks for coming in.
Thanks, James. Appreciate it.
Exciting time for small caps. We've seen some moves in the Russell, the US small cap index, up about 12% for the year, a little bit of a pop last month. You've been following these moves and is it getting a bit hot under the collar?
I feel like I've been hot under the collar for about two years.
You and every other small cap
manager.
manager.
I know, but I remember I think we were chatting a couple of years ago. It was mid 2022, and I was saying the exact same thing. Like the divergence between smalls and large, was at probably the highest in terms of a financial year we've ever seen, and it's just continued. So I think the Small Ords has underperformed the All Ords index by just over 20% in Australia, but in the United States, the end of the financial year, 30 June, it was even worse. It was over 30%. So, I mean, what we've seen so far in July with the Russell, is probably, you've seen that the Russell outperform. It's come back to where Australia is now in terms of that 20% underperformance over the last, call it almost 3 years. But yeah, it's very positive signs, and fingers crossed it continues.
And was there a particular catalyst, do you think, for that move?
Oh, definitely the inflation prints that we've seen in the United States have been softer and have missed expectations. I think as well, and we've seen this in the Australian market, where you've seen this concentration risk in sectors and obviously the Magnificent Seven over in the US, and that's where all the money has been flowing into. And these are incredible companies, but the valuations just keep getting higher and higher and higher and higher. And all it takes is for a little bit of uncertainty, and suddenly that flow of money might flow into small caps, which is what we've seen through July. So look, it's only 1 month. I'm not getting too excited, and certainly we haven't seen it in Australia. I think small caps have underperformed large caps so far in July. But yeah, as I said, it's a good sign, and hopefully we see mean reversion over the next coming year.
You've been researching or investing in small caps since 2010. How relevant is the US market and particularly US small caps for Australian investors? Is it something that's a little lead indicator, something to keep an eye on?
Oh, it definitely is. But I do think you need to be careful. So I think what we've seen since COVID is the US has largely been 6 to 12 months ahead of Australia, whether it was being at home and companies like Zoom started to rally, and then in Australia a few months later it was Temple & Webster and all the e-commerce names, and then we had the great reopening trade where travel went really well. Then we had inflation, and now hopefully we're getting declining inflation. So it definitely leads Australia. But I think as a small cap fund manager or an investor in small caps, when you start getting too focused on the macroeconomic environment, you can get lost. And I certainly remember there was a period a few years ago I was a bit like that. But because you should always just focus on your stock picking, your process, you can always find unloved or interesting companies no matter what market you're in. So yes, so the answer to the question is yes, we are looking at the US. Hopefully it's very positive for Australia, but again, you still got to just follow your process and you'll always find interesting companies.
You wrote an article a little earlier in this year saying the opportunity set in small caps was the best you'd seen since 2020. Could you talk me through some of the things that you're seeing that are contributing to that view? Why is the opportunity set looking so attractive?
Yeah, I mean, it's just a simple fact that the vast majority of the small cap index is in companies exposed to the economy. And a lot of these companies in sectors such as retail, real estate investment trusts, building materials, automotive, media, these companies are trading at valuations that are very, very low. Also, what we've seen is a lot of these companies have come out of, say, the large cap index and come into the small cap index. So the actual weighting to those sectors has actually increased. So if you're going to be positive on small caps, you need to be positive on those companies and those companies exposed to the economy. So I would say that there's that element. I'd also say that we haven't really seen capital markets activity for a very long time, and consistent capital markets activity. And I think, we had a ray of hope about 3 or 4 months ago, and then again, it declined. I think last year was pretty much on par with 2022 and 2023, which was about 70 or 80% down on the 2020, 2021 years. So if we get that coming back, that will be very positive on small cap companies, because obviously they're smaller companies, they need capital to grow. So we might see more acquisitions, we might see more IPOs, and that fuels demand into the small cap market. So I'd say there's 2 elements there, James.
We're in July now. There's still a good chunk of the year to go. Is there any indication that that capital markets activity is going to pick up? Are the phones ringing? Have you got brokers coming to you with more ideas?
I think there's a huge pipeline. There's no doubt about it. And I think when you get that ray of hope, and certainly we've been seeing that over the last couple of weeks. There's been a few things. And certainly towards the back end of last year, there was some great deals that occurred, such as Generation Development Group. That was a really good deal. We're seeing more block lines and so forth. Sell downs occur, and most part they have traded a little bit better than they have historically. But I would say, look, everyone's just waiting, and I think it's just purely off. We just need more confidence that rates are coming down, and I think there's a lot of companies with very strong balance sheets, which is something we've said consistently over the last few years, particularly in the small cap market, which is why we've held low levels of cash across the portfolio. So we do think we will see a lot of M&A, a lot of acquisition activity, but we just need management teams and boards to be confident that this is the worst. The macro will improve from here. You
touched on it there around your cash holdings. Traditionally, my understanding is that Wilson Asset Management has held higher levels of cash than people would traditionally think in a portfolio. Where are your cash levels now, and is that higher or lower than long-term averages?
Yeah, so I think for some time, it's really been around 7 or 8 years, we've held lower levels of cash. So in the period up to there, we were, in some instances, we would be well over 20%. I think from over the last 7 years, our average would be somewhere between maybe 14, 15%. At the moment, we're ranging around sort of 10 to 12%, which has been pretty normal over the last few years.
Yep. And what are some of the ideas that you're most excited about in the portfolios right now?
There's a lot of companies, I think a lot of small cap fund managers would feel like this, where you sort of look at the chart and you go, whoa, they've had a very good run over the last 12 months. The concentration risk we've seen across the Australian market in large cap companies such as, with the banks and, companies like Wesfarmers and so forth, which have done incredibly well. I mean, that does exist in small caps as well. Now, those companies are great companies, but you need to keep checking whether the catalysts are still there and whether there's still valuation upside. So, to answer your question, we think that, you potentially should be in a market where you think interest rates could be coming down. You need to be taking a little bit more risk. And sectors such as healthcare, we think looks really interesting. Financials, retail. We think the New Zealand market looks very interesting, given it does appear that the RBNZ might be the first, developed nation or one of the first to cut rates very soon. And we actually think that companies with a lot of leverage look interesting. So, which have obviously been impacted massively over the last few years.
That's not something you hear a fund manager say every day. Usually it's, hey, we like low levels of gearing.
Well, that's what I'm talking about. But I mean, if you look at a company, say, Integral Diagnostics in the diagnostics imaging sector, I mean, that to me looks like a very interesting company at this juncture, because you've got radiology volumes which are starting to increase again. They've fully cycled all the issues from COVID. You've got wage inflation, which is starting to normalise, which has been a big impact on their margins. But if we get a scenario where interest rates fall, suddenly we're pushing through quite significant earnings per share upgrades, just simply because our interest expense is potentially going down. So that's the sort of style of company we're looking at the moment. And there's a lot of companies in the small cap market like that, which used to be market darlings, and the valuations come right down because of fears on the balance sheet and the macroeconomic environment that we're in.
You mentioned before about it being a time where, as a small cap investor, you should be thinking about potentially taking a little bit more risk in the portfolio. What are some other examples of how you're doing that?
Yeah, so I mean, a good example maybe in the healthcare sector, a company such as Healius, which has been probably one of the worst companies in the small cap market for a number of years. The key catalyst there is they're looking to sell their radiology division. Healius optically looks, balance sheet looks really, looks tight. They're at 3 times leverage, but in our view, if they sell the radiology business and get anywhere close to what the valuation that's been reported in the press, suddenly you take a 3 times levered business to effectively their cash, and now they've got all these other options. And at the same time, you've got the pathology market, which we think has bottomed and is starting to recover. So and if you look at the register of Healius, you've got 10% of the register which is short sold. So, if we're right, we think the shares could go up quite a lot because those short sellers might need to cover if their thesis is proved incorrect. So that's a good example of a company. Another one which we own quite a lot of is G8 Education in childcare. It's been a very tough stock for a long, long time. It's got a new management team and board and been doing the right things over the last couple of years. They've been getting out of some of their problem centres, really streamlined their cost base. But now you've got a period where the government is potentially very supportive of childcare through their policies and also looking to support women in the workforce. So we think their cost base is effectively fixed now, and any sort of occupancy improvements they get should fall at the bottom line. They've got a really good balance sheet and they could do a share buyback, for instance. So that's a company that's on 11 times earnings. It's been forgotten about, decent sized market cap, but it's been out of favour. So they're the sort of styles of companies that we're looking at the moment, which there's a lot of them, and that's what makes us excited about small caps.
And what are you avoiding? Are there any parts of the market? I know it's generally a stock-by-stock basis, but is there anything that you're steering clear of at this point?
I wouldn't say there's any particular. Sometimes it's very clear that there's sectors that you don't want to be in. I don't think we're at that point yet. I just think there's a lot of companies where the valuations have gone up a lot, and you need to be very, very confident that the catalysts are still there. They're the dangerous companies, in my view. If you think, as I said before, if you think the small cap market's going to rally, it's not going to be in the sectors probably that have been good over the last 2 years. So I'm thinking, sectors such as industrials and technology have been very, very strong. There's still great companies there, but the valuations are high. It's really, for me, I think it's hard to see these companies continue to re-rate through over the course of the year and actually outperform the small cap market because they've just done so well. So I think you need to be careful of those style companies, particularly if the valuation's getting up there and it's running out of catalysts.
We're coming into reporting season. It's not too far off. How are you feeling? How important is this reporting season for you? Do you feel like you have a good sense on where the earnings of these companies are at the moment? Are you expecting it to be a bumpy ride?
It's always a bumpy ride, but I'd say what we've seen so far, which is very exciting, is a lot of the companies that have underperformed over the course of the last couple of years, it might be coming out with sort of inline expectations or slightly better than what people think, and they have been rallying very strongly. So this reporting season will reward stock picking. It'll reward taking potentially some risks that you haven't taken over the last couple of years because you've been nervous of the market. So that excites us as stock pickers for sure. And if you have this situation where, if it continues in the United States, people will look at that as a lead indicator for Australia. As I said, New Zealand looks like they'll be cutting rates soon as well. So we do think that, particularly for some of those bombed out companies, we might be getting to the point where we actually might even see some companies downgrade earnings expectations and they start to rally. Given their valuations are so cheap. So that, to us, looks very exciting into reporting season.
Let's get into a few stocks, because I just had a quick glance at a few of the companies that you've gone substantial in, in recent times. So maybe we can go through a couple of these positions and you can just run me through the thesis on a couple of these names. So let's start with ServiceStream. It's a name, it was a darling stock 5 or 6 years ago, sort of seemed to drop off the radar. What's the thesis there? Yeah,
it has. And we actually think it's in a much stronger position now at a much lower valuation than it was a few years ago, where it was just largely driven off the NBN and the telecommunications industry. So the business today has really come out of a tougher period where they had a problem contract in their utilities division. That problem contract's now finished, which is great. All three divisions are now growing very strongly. Following their acquisition of Lendlease's services division, the business is much more diversified and not wholly reliant on that telco segment. Now, what we find interesting with the company is around a year ago, they decided to spend, I think it was about $7 million investing into the defence sector as a fourth pillar for the business. Now, you see these scenarios sometimes with some companies, though, if they're successful and they win a defence contract, suddenly that $7 million investment becomes break even or profitable, which would be fantastic. However, if they're unsuccessful, then the $7 million comes out of analyst numbers and as an earnings upgrade anyway. So we think you've got a free option on that defence strategy that they're doing at the moment. And Lee, the CEO, has been there for a long, long time, and we back him. He's done a really good job. Business would have been in a lot of trouble if they didn't make that Lendlease acquisition. And again, net cash balance sheet. So we do think they potentially could acquire as well, and it's a cheap valuation too. So, and their closest comp in the small cap market, Ventia, I think is trading at a 15% premium to Service Stream. So we really like that one into August.
Okay. Next one, bit of a checkered history.
Yep.
EML Payments.
Checkered. Geez, that's nice. Shocking. EML. Before they did that PFS acquisition at the end of 2019, I mean, it was a business that did about $35 million of earnings and traded on a very high valuation. And this is in their reloadable cards business. Now, what happened? They did the PFS acquisition. It was a disaster. And over the last 2 years, it's been cleaned up, and to the extent where it's now been fixed, and it's been exited. And so the management team, the board, has done a very, very good job there. Balance sheet's in great nick. They've just got to complete the sale of the Centennial, which should happen in the next few weeks. And they'll come into the 25 financial year with a clean balance sheet, really good balance sheet. Now, very simple thesis from us. So effectively, when they were doing $30 million of EBITDA, there was 0% interest rate. So they were earning no interest revenue at all off their float. Today, with interest rates higher, they're earning, call it $40, $45 million of earnings, just purely off interest revenue. And I think the guidance that they've given is, call it $50 to $55 million, so something like that. So effectively, that $30 million business that I talked to you about earlier has gone to, say, 10. And we think that's prime for growth, given where the balance sheet's at, given a lot of the compliance issues post-PFS, there'll be a lot of costs coming out of the business. So we actually think the EML business could do sort of $70 to $80 million of earnings quite easily over the next couple of years. It's a classic turnaround style business that we like. We see good catalyst for that one. And again, it's very cheap.
And probably still quite unpopular.
Very unpopular. Very unpopular. There's probably quite a few of my peers that probably never touched it again, which is probably fair enough. But we like those sort of style companies.
Fortune favours the brave. All right, last one we're going to talk about. This one is a bit down on its luck at the moment when I was having a look at the performance. This one's SmartPay. Looks like it's had a pretty tough 12 months. What's the thesis? What are you backing to turn it around?
Well, it's had a tough 12 months, but this is the time to buy it. So, the tough 12 months that it's had has just been a product of a tougher consumer environment. Payments industry just generally, Tyro's had the same issues. Small businesses, it's been tough in hospitality and also in retail. So their net terminal additions that in Australia have slowed relative to the consensus, the analyst expectations. But the key reason to own this stock is what they're doing in New Zealand, where the unit economics are changing in terms of their business there, and effectively, there's the ability for that New Zealand business, once it's transitioned to how Australia operates, that could double the earnings in the business in the next 3 years. And we're coming to this point now where they're starting to roll this out. So we actually think we've been buying the stock. We've increased our substantial, where I think we're about almost 10% or maybe slightly 11%. Are we? Okay, there you go. Jeez. We're very bullish the company. This is the time to own it. And we think you're getting a free option on that New Zealand rollout right now. So, we're very bullish on that one.
Okay. IPOs, there haven't been that many of them. Guzman and Gomez.
Yep.
Did you buy the burrito?
We didn't buy the burrito. Probably should have. Look, at the time, it's a great business. Management's fantastic. It just came down to valuation. And I think, look, we had a lot of, we've got a position in Collins Foods and you had a decent position in a number of retail stocks as well. So the question is, do we sell something else and buy Guzman and Gomez or whatever? And we chose not to, but hindsight tells you probably should have bought it. It's done very well.
As I mentioned earlier, you had 14 years since 2010 researching and investing in small caps. To finish up today, what do you think is the most useful practical lesson that you've learned about investing in the space over that time?
Particularly for us at Wilson Asset Management, when mistakes are made, it's when we go outside of what our investment process is. So we've got a very strict investment process, focuses on earnings growth, quality management, quality of the sector that the company's in, but you need a catalyst. And I often find when we're constantly, as a team, there's 6 of us, when we're testing each other on our thesis on certain companies, it's when you sort of go, where's the catalyst? Oh no, that's disappeared, but that's fine. It's all good. Like that in small cap investing, you always got to keep focusing on what the next catalyst is, and often that's where we make mistakes. Is if there's no catalyst, And often when there's no catalyst, you see the valuations start to come down, or it's, maybe a company's waiting on a contract and lo and behold, the contract never comes. So yeah, I think it's always follow your process. A number of the funds, or my peers, have great investment processes that stood the test of time, and retail investors too. Effectively you've got a reason why you invest in a company. If those reasons disappear, it's usually a sign that maybe you need to sell the company, because a lot of the catalysts have disappeared. So yeah, for us, definitely at Wilson Asset Management, just adhering to the process at all times.
Well, Oscar, it's been great to catch up. Good to get a bit of a deep dive on the small cap space, and good luck for reporting season.
Thanks, James. Appreciate it.
To all your viewers out there, I hope you enjoyed this episode of Views from the Top with Oscar Oberg from Wilson Asset Management. Remember to check in to our YouTube channel. We're adding fresh content just like this every week.